Today is Saturday, September 5th, 2015. This is Clueless8, Frank, and I welcome you to this impromptu Labor Day weekend open-ended webinar for everybody, members, free trial subscribers, StockTwits followers, you name it, anyone out there, because I felt like I thought it was quite important for me to share a couple of observations, not ideas necessarily, but observations and strategies and things that we can employ given the turbulent markets that we're going through, to say the least, okay, to say the least. Full disclosure, this webinar is purely for educational purposes, informational purposes, and not for any solicitation or financial advice. So welcome. So first of all, I want everyone to make sure that they can hear me clearly, and of course you can type in your questions directly on the chat box. Allow me a little bit of time to go over a couple of things before I start addressing some of your questions and queries, and also make sure that you see the screen. I'm not going to delve too much into the deep technicals and stuff because, you know, those are in the advanced coaching sessions and stuff, obviously. But we're going to cover some relevant points, you know, that are important to all of us. Make sure you see the screens and that you can hear me clearly. So what I'd like for all the attendees to do at this point is just type in a Y for yes directly into the chat box. So I make sure that we're on the same wavelength. Please go ahead. Okay, keep going. Okay, I like that. A lot of Y's, a couple of yeses. All right, so let me just kick off here. All right. First of all, let's move back a little bit. Let's put things in perspective. Very clear. Try to keep this succinct and to the point. So here we have a chart of the Dow Jones Industrial Average going back to 2009, right there. All right, this is 2009, the depths of the market at 6,400 or wherever we were at that time. Yep, 6,500. So here we are where we are today. It is very clear, and we don't need to do some advanced rocket science technical analysis, that the trend for now is broken. Let's face facts here. The trend for now is broken. The uptrend that so far we have enjoyed all the way from 2009, if you look at it in a very simplistic manner, which is draw the uptrend line, you can clearly see that that trend has been broken right now. You can see that very clearly. Now, the good news is that trends can be broken and trends can be recaptured back and all kinds of stuff can happen in the market. But the good news is, and the silver lining is, that as traders, as people who are tactical investors, I think that's the best way I can put it, you can always try to make some money. The key word is try. It is not easy. It is not a cakewalk. It wasn't even easy when things were going higher, because there were a lot of choppy, volatile situations along the way, including this large-scale volatility that kept a significant amount of traders and investors, including many of us, or many of you, I should say, and myself included at times, out of getting the big, fat, huge gains that this market offered since 2009. Let me be clear about one thing here. I'm not going to say that this is the most hated bull market out there. You hear that term quite a bit. Somebody's saying, sorry, we can't see the full chart on the bottom while you're pointing. Okay, let me make sure that my screen is okay. I see what you're saying. Let me see. Is that better? Okay, what I'm going to try to do is, bear with me 1 second. I'm going to try to get the bookmark tab out of here so that we can all be, I think that should do it. Let me see. Because watching the screen is important. Yeah, well, that's the best I can do here. Okay, so you just have to go with it. 2009. Okay. All right, good. So good to me. So let me get back to my chain of thought. So the reality of the thing is that I'm not going to use the term that it's the most hated bull market and stuff like that. You hear a lot in the media, but I will tell you that it's been the most cautious, and I'm talking my personal observations, okay, and my personal experience. It's been the most cautious, most ignored, and in some cases, the most reviled bull market that we have seen since 2009. It is a fact. Now, for different reasons, a lot of it has to do with ideological reasons, which I am not into ideological warfare. My ideology is very simple. People who are listening to me for the first time, people who have come in from the stock twit sides, just so you understand that I have a very simple ideology. I love the United States of America. It's really as simple as that. I have gone through many different continents. I have traveled extensively. And I do understand global cultures, I would say better than 99.9% of traders and investors out there. So when I'm looking at the fishbowl, I'm looking at the fishbowl from the outside in instead of inside out, that a significant majority of traders and investors and US-based financial professionals do. They're always looking at the world from the fishbowl that we're in, looking out. I like to look at it from the outside in. So when I look at that, I find a market deep, liquidity-wise, very open. I find a market where you have huge amount of choices, where anybody with any reasonable capital can participate in. I find the speed and technology that's offered to us, which I am a living testament of that, as you all are listening to me, where I can start off my own business after leaving Wall Street in 2010, after working for a hedge fund outfit for about a year, and then completely branching out on my own in 2011, only been 4 years, and trying to share and suggest and share my experiences and my stock market or stock picking skills, whatever you call it, with everyone, is all because of this fantastic technology that's offered to us in the United States of America. So the reality is that, without getting into a Trump styles like, USA's great type of stuff, the reality is that we are in a very advantageous position, in the sense that we, with some reasonable acumen, guts, knowledge, speed, power, technology, everything included, we can still make some very decent money in this market. It's going to be difficult, but it is and will be done. Let me clarify one thing here. Losses, and I don't need to repeat to some of you have been in the market longer than I have, and you guys understand this, but it is important for me to reiterate that, is that losses are just part of the game. There'll be a week you'll be down on your P&L. It's good to look at P&Ls on a weekly basis, to be honest with you. Daily P&Ls are important for traders, but honestly, they really screw around with people's heads, in my opinion, because of the volatility in the market. So it's hard, because we do a lot of wrong things, completely erroneous things, because of our faulty EQ or emotional quotient. When our emotions take over, very difficult to ignore emotions. After all, real money is involved here. We're not the Saudi king who arrives and there are 600 S500s and 600s waiting for him on the tarmac at Andrews Air Force Base. And this morning when I read that, it just blew my mind. The Ritz-Carlton completely, took over the whole hotel. Guests were shifted out to other venues because the Saudi king and his entourage is there. Well, we're not Saudi kings here, right? So the bottom line is that money matters, and we do care when we're down, when we're red, whether it be a couple of $100, whether it be a couple of $1,000. So we make stupid decisions, but that's okay. We just have to fight it every day. So if you keep emotional quotient sort of managed, I think we can move forward. So let's take a look at the market here. So the trend. So if I look at this chart here, it's telling me different things. It's telling me that we are going to, if we have this crossover, that's good. That's what you call, and I've explained this clearly in my coaching sessions. This is a weekly chart, multi-year chart, 2009. When you start to see this, and I'm zooming in now, the 34, which has previously also, all the way back in 2012, it did that. It's starting to curve down and cross over the 50-day moving average. You can rest assured that we are going into a mini bear market. Now, what's a bear market? A bear market is simply a market which is basically going to remain down, more than 20% correction, all that stuff. Forget the numbers. A bear market is basically where you sell rallies and you buy, you buy the dips and you sell the rallies. In other words, it's sell the rally mentality. It's really as simple as that for traders. Let me just make sure that this thing always freezes. Bear with me. So once we see that crossover, and we won't find that. Bear with me while I sign over on the other side. We won't find that till probably a couple of weeks down the road. A couple of months down the road, we probably won't see that. And if it does happen, you start to see that crossover as we're starting to see it happen, you do not want to be a hero and decide that, oh yeah, everything's really good and everything's going to turn around and go back to its high. It's just not going to happen. So as traders, we have to be cognizant of that and we have to act accordingly. Bear with me 1 second as I sign on the other side with my super secret passwords. All right. So at this point in time, the juncture that we're in is we have the normal technicals that we use on a shorter term basis don't seem to be working for a simple reason. And that reason is that markets are just out of whack. Now, what does out of whack mean? Well, out of whack basically simply means that the markets are being run completely at this point in time, 100%, I would say, by the algo HFT, high frequency trading programs. So when you have that type of situation, it doesn't matter what type of short-term analysis would do, what time, whether or not something is oversold or it's going to bounce, and some of the positive divergences that I keep on showing. Just be completely cognizant of the fact that they can change for no reason. No rules, no technical rules need to be followed. Can change immediately, within a minute, within half a second, within literally 10 seconds. So just be aware of that. Now, it doesn't mean that you can trade oversold bounces and you can trade overbought sell-offs. Sure, you can. But the reality is, just be aware of that. Now, looking at this chart here, we have a couple of things going on. Nothing goes in a straight line, all right? Even the crash in 2008, 2009, after the highs of 2007, did not go in a straight line. There were large bounces along the way, and they moved. The simplest way to look at it is the first magnet, which is the 50 and the 34, tend to act as magnets. So as you're falling, as this fell, for example, all the way back in January of 2008, you get a quick magnet up to retest whether or not this is a real deal. Now, the crossover happened here. Now, this is something important for people to keep in mind. The crossover happened here on February 29, 2008. Okay, so people who shorted the market at that crossover basically got demolished, because what happened right after that? You get a massive move up. You get a massive move up from 11,655 to 13,118. This move here, to test this downward sloping negative crossover of the 34 and the 50-day moving averages. So who's to say something like that won't happen this time? Let's say the same scenario plays out and we are going into a bear market. Let's say we're going to go into a bear market for a year and a half. Whoopee, great. We have enough instruments in our hand to basically make money on the downside. But if you think it's going to be one linear bet, one straight line bet, where you can short things and just go away, well, you can if you're not watching your P&L on a daily basis. Because in my opinion, I still think we are going to come down and test this 14,000, and it could happen very quickly. And I've mentioned this before. So let me just change the color. Why is this 14,000 important? I don't want to skip too fast, but just so people know that. Is the 14,000 important because this was a significant multi-year breakout from 2007, 2013. And let me tell you, when that breakout happened, nobody was excited. You know why nobody was excited? Because the majority, and I mean that, were not in the market. They were all still moaning and groaning and, you know, hating every single rally, just the way they were doing here. So again, I'm deviating, but I'll cover that in a second. The behavioral aspect of the market, the behavioral finance aspect of the market. So here we are. Bottom line is that we are going to this 34 and the 50. So the crossover happened here. Just remind people, February of 2008, at the end of February 2008, and then we had a big, like they say in New York, a big ass bounce, okay, on May of 2008, and which started with a double bottom in March, and they just couldn't believe it. Okay, trend is down, by the way. Trend is down. So let's say the same scenario. Let's look at it. Let's say the same scenario is happening, and that we are. Just assume for a while. In fact, I am, pretty sure about this, that we're going to test 14,000. Now, whether it's going to happen by October or whether it's going to happen the first part of next year, I have no idea. But the speed and the ferocity of the machines and the global dynamics that are being played out, where chunks of large hedge fund and sovereign fund portfolios, and even Leon Cooperman, Omega Advisors, one of the best minds in the business, brilliant guy, okay, who said what I've been saying for months now, that a good significant portion of these flash sell-offs that are happening is because of algorithmic high-frequency trading programs that are hitting the markets, counterparty risk, all kinds of stuff. Same words that I use, except he's a lot richer, and he manages a lot more money. I don't manage any money. I'm just a clueless trader. So the bottom line is that he's saying the same things, which is true. So given that the backdrop of that type of technological speed, I honestly, a 2,000-point drop between now and October, I see that. And if we do get there, we are going to flush out literally every single sector which is somewhat overvalued, massively overvalued, the junk bond players, the high yield market, you name it. It's going to be a full scale flush across the board. All right. So in a way, I'm hoping that happens. In a way, I'm not hoping that happens because it's going to hurt a lot of people. And the mass psychology of people who never bought into the bull market and who don't understand technicals to start with, okay, is going to be demolished. So that's going to cause other type of negative repercussions in the global economy, which could lead to a short-term global recession. Remember, markets have impacts on people's minds even if they are not directly invested in the market. Everybody's indirectly invested in the markets, remember, through 401ks, through you name it, through all kinds of different instruments that are out there, pension funds and everything. They don't realize it, but they are. So the point is that that you are going to see a mass negative psychology, which itself could have a negative wealth effect, as we know, and that could cause depression in housing, all kinds of stuff. Things are just building up. So we don't necessarily, technical junkies like all of us, we would love to see it down here, no question about it, and see a beautiful bounce from here, 2,000 points, and then we'll see what happens. A retest possibly a 17,000, that kind of stuff. But for the mass psychology out there, it's no good. And if the U.S. housing market, which is a pillar of the U.S. economic growth, and also sustains a significant, puts a lot of juice into the global growth dynamics. If that starts to falter, I can rest assured, you guys can all rest assured that it's not going to be a good thing. So technically, fantastic washout. From a mass psychology, from Main Street standpoint, not good. All right. So whatever the case may be, we need to be cognizant of that. So in the meantime, where we are right now, we have a significant bottom here. So if we hold this bottom, which is pretty much stone's throw away as early as Monday, we could get a bounce. Now, like I said, these are multi-month bounces, which attract where the magnet is your 34 and the 50-day moving average. So let's look at it from a technical standpoint. The 34 and the 34 and the 50-day moving averages right now, which have worked very well for me, are trending somewhere around the low 17,000 because they're turning to. Let's say we have a crossover because the market keeps on going down next week. So whichever the case, we have a good shot to basically come and engage that. So if you come and engage that, you are looking at roughly about a 1,000 point bounce on the markets, regardless of the fact that we are trending and the directional trend is lower. And that 1,000 point bounce in the market, if and when it happens, has to be respected and monetized. What does that mean? It means we have to make some serious money off that. On the short side, if we break this level here, which I've shown, which is below, which is the 16,000 level, let's say, we could have a quick free fall again to the lows of the flash crash Monday, Black Monday, 2 Mondays ago, which is around the 15,700. I can't, I don't remember offhand directly the number, but we would basically do that, and at that point there will be a reactive bounce again, and all kinds of stuff. Otherwise, if things are really falling apart, then we are going to fall rather rapidly in between little zigzags. We are going to fall rapidly towards the 14,000 level. At that point, there's no stopping it. Just letting you know. And that would be a significant washout, and would bring in a good amount of cash that's been sitting on the sidelines, scared of the market, scared of the bond market, because the bond market, there's fears that rates might rise and all that stuff, and scared of everything that moves, but they will be forced to come back in the market. So there is a silver lining to this picture here. All right, now let's take a look at some shorter term technical. So that's a broader picture. Now looking at this here, did this freeze again? I guess it froze again, so I'm going to give up on this. So looking at this here, you can clearly see the stochastics are quite oversold, but oversold can remain oversold. Remember, oversold bounces don't have to occur within a day, 2 days, a week or so. Oversold, just the way overbought can remain overbought. You can see here for months in a row, you can stay oversold for a couple of weeks, months in a row, before it turns again. One way or other, it will turn. There's no question about it. My job is to be one step ahead, or try to be one step ahead before that bounce occurs. And remind people that we can remain oversold and zigzag down further, as I've explained. So technicals are not like precise. 1 + 1 doesn't equal 2 on the technical arena. It's like art appreciation. You have to know, you have to know, you have to basically keep it fluid. How about that? So let's take a look at some shorter term pictures on what's going on. So I'm going to stick to the 1 hour chart. And the 1 hour chart, believe it or not, is somewhat positive. So here we have this burp, all right, on the positive divergence that's going on here. So if this replicates, it's pretty easy to see. It's pretty easy to see that you are going to see that you're going to basically make a move into this gap here. Otherwise, you're going to come down to the bottom of this Bollinger. You're going to test this low from the beginning of last week. And is it possible, given the complete erratic behavior of the algos and stuff that are hitting the market, that we slip straight down? It sure is. So what are the next levels? The next levels we already know. This is the extreme level. There is a support level here. So all these are pretty clear to see. But in the meantime, the real effectiveness of this Clueless8 service will be my ability to determine by looking at many different things, not just this chart, and giving you guys some sort of early warning and or early goodwill signs, if you want to look at that way, of which way the markets are heading. All right. So if I can give you that, you're going to make a significant amount of money. Now, in the meantime, you have to, from a tactical trading standpoint, you have to keep your sizes reasonably small. You have to react quicker, and you have to be aggressive in buying runaway rallies, reactive rallies, and shorting through the various instruments that we use, whether it be the index puts, whether it be the ETFs and the ETNs, the inverse ones. You have to be aggressive when they are falling. I wouldn't recommend anyone to keep large overnight positions open, because regardless of what the technicals are, you never know what happens the day before. I mean the night, the following day, because so much happens in the futures market. That brings me to a very important point, and that has to do with I'm going to put up the IWM here. That has to do with the fact that a good portion of this forced institutional and all that stuff is also happening in the futures market. The futures market, the E-minis and all those, the Russell 2000, the TFs and all that stuff, these are not just numbers. These are currencies. They're money. So they are also, they're also resetting and dumping and using that currency to settle all kinds of different monetary settlements that have to be taken place. So I will answer that question in a second. So the bottom line is that I will answer Ratna's question in a second, because it's a very, very good question. So the bottom line is that you just have to be, we just have to be on our toes. And I'm always on my toes. Even when things are good, I'm on my toes. So to me, this is an exciting time. I'm telling you right now, because these are great learning experiences. I have gone through a bunch of them, and I will tell you that this one is, because of the advent of these new technologies, the HFT programs, and far, far more advanced what they were a couple of years ago. This one it's dynamic. It happens a lot quicker. What took weeks, I repeat again, takes literally hours, if not days. I would say hours. So the rapidity is something that we need to get control of, without getting too dogmatic on one side or another. And I've explained what the bigger picture is. All right. So I'm just collecting my thoughts. So let me answer this question here. Okay, Bhargav Patel. All right. I'll be very honest with you about something, Mr. Patel. All right. I don't switch around. I don't switch around these. I don't change the parameters, because as a non-traditional technical analyst, in my opinion, let me put it this way, in a very simplistic way, switching around, and he's asking about. I think all of you can see the questions being asked, right? So he's saying, why do you have your parameters on the stochastics, such and such, as compared to 20, 10, 10. To me, switching those numbers and playing around with them makes a hill of beans difference to what money I'm going to make. Because the reality is, it's more the directional move, the timing. So me trying to be a uber technician, which I am not, and sitting there and tweaking around little numbers, and anyone can do that. Obviously, there are 500 different technical indicators people can use. Okay, I use some basic ones. I use the stochastics. I use the vortex indicator. I use the MACD and stuff on my other charts. I use the money flow at times. I use the Kopach curve. So I use a bunch of the ones which I think are easier to read. So what I'm getting at is, by tweaking these minute numbers, it's not going to help me land on Mars. That's the reason why I just use the default what's there. Thinkorswim has that. Thinkorswim has that. So let me just pull up, detach a window. Has a fantastic number of ones. But I do know one thing. that depending on what platform I'm looking at, they do look different. And so here's Thinkorswim, for example. I was looking at Priceline end of the day. I mean, that was a phenomenal reversal. But let's just put, let's say, for example, the SPYs. So that's the answer to your question without harping on it too much. I don't go around tweaking things around that much, and I just use the default numbers. There you go. Okay, everyone see this? Let me just address this other quick question. With the U.S. economy expanding at solid pace, why do you think we have a bear market? All right. I'll tell you one thing why we could have a bear market or a short-term mini bear market. We could have a short-term mini bear market because all of a sudden, a lot of these structural derivatives that are that have fallen apart on the emerging markets, thanks to the China devaluation, thanks to the corresponding ripple effect in Thailand and Kazakhstan and you name it, Turkey, some major emerging markets. Okay. The bottom line is that it is possible that it quickly, for a short time, pulls the global economy into a quick tailspin that causes us to pull back. Our exports are definitely going to be affected, no question about that. So that would what cause a quick quote-unquote bear market. Now remember one thing here, and you heard it here first. Bear market generally they say lasts 12 to 18 months, right? But because of the speed and rapidity of the technology that's controlling the markets, the bear market can last as short as 3 months. I know I might sound crazy, but that's just the way it is. What happens in, there's an old saying. There are sometimes, things happen. Sometime, what's the word? Weeks happen in decades. I forget. It was a great term, and it's going to come back to me in a second. So these are these weeks, basically, decades, which have been compressed in weeks. So what I'm getting at is that whatever the bear market, if that scenario does arise, it's going to be quick, it's going to be compressed, and it's just going to, it's going to come and go. It's not going to be long-winded because we do not have a credit crisis. Our banks are very well capitalized. The central banks are very easy on the monetary policy. And as long as we don't have a rapid succession of rises, accelerating interest rates, whether by the market or by the Fed, then we're going to be fine. If we do start to see the Fed, as well as the market, which always does it for the Fed first, start raising rates on a rapid succession, i.e. the trajectory is fast or the acceleration is fast, we are going to fall into a bear market. But aside from that, we're going to be okay. Just, passing it on to you. So let's take a look at the SPYs here and what we can see here on a short-term basis. All right. So here on a short-term basis, this is very clear, right? This is a daily chart, and these are things that I'm starting to notice here, and I do not have an answer for it, and I'll know the answer very shortly. It looks like we still have a positive divergence going here. Now, it's possible because we haven't fallen apart yet, but generally speaking, this is considered to be a positive divergence. The other thing that I'm noticing in my other charts, and these are the sort of the silver linings, is that the MACD selling pressure, the histograms, and I'm going to show that on the 533 swing charts, and these are sort of my secret sauce, is not showing any deep, massive selling pressure by the large institutions. So whatever is happening, in other words, what is a positive divergence? A positive divergence is a divergence of price and the internals. And depending on different internals you're looking at. In other words, price can come down lower, but the internals are suggesting that there is accumulation going on and that things are going to move higher. Now, so that's number one. Now, this is last October. For similar but lesser reasons, we fell apart. Ebola, high yield bond tantrum, all kinds of stuff. Similar kind of stuff here. We did not have a global element to it, but still. And it was a dramatic move. Dramatic. Like to remind everyone that this was almost a 2,000-point rally after a 1,200-point drop. And I would say a good portion, what good portion? A majority of traders and investors we're so scared they didn't get in probably till there, and then we had a quick correction, and then the volatility cycle started. So is it possible that we have that type of scenario here? Well, looking at the chart pattern over the last couple of days, the answer is no, because we did not have this type of rapid, or I should say vapid. Well, look it up, that $5 word, okay? Vapid volatility here. We did not have this. Doesn't mean this can't be repeated. The internals are somewhat same, which is interesting. The internals are somewhat the same, but the external surface, which is the actual charts and the prices, are not the same. So whatever the case may be, we're going to be monitoring this very closely, because they're different. I mean, I've explained this, and I want to go over that again, that it is very possible that on a short-term basis, we are going to come down and test right here, the 187 level. But then at the same time, somebody pointed out, and I showed this too, that this is actually a large dragon bullish market structure low, and one of those convoluted bullish patterns that no one sees till it gets done. And therein lies the secret of, I would say, profits, because till it goes up here, nobody realizes that was the case. So my job is to look at many different things and figure out whether or not this is this pattern, or whether it's going to be down here before we make another solid bounce from here. Whichever the case, this downtrending 34 and 50 line, downtrending 34 and 50 line, and this these white lines here are the acceleration band. So we are the bottom end of the acceleration band. Okay, right there. Let me get that drawing tool again. I don't know why it keeps on disappearing. Right there is bottom end of the acceleration band, mid acceleration band, upper acceleration band. Forget the upper acceleration band. Let's look at this and this. So in between here, here's 200, or roughly 2,000 on the S&P, 1990 plus, and this is where we are right now. So you can draw a floor pretty much at 190, and I showed this in my charts very clearly, that between 190 and 200, in my opinion, is where we're going to trade at for the month of September. So 10 S&P points, you're looking at roughly about 800 Dow points back and forth. That's what we're going to get. Let's try to take full advantage of it, because there are a lot of stuff going on here that showed up on the screen on Friday, which was very interesting. Priceline was one of them. LinkedIn was one of them. There's a whole bunch of biotechs which were green. Stuff going on, okay? So we have to be very cognizant of that. All right. The other thing I want to show you guys is the picture of a direct picture of the VIX. So here's a daily on the VIX, way out there, way out there. So here is what, if the VIX is going to be an early warning signal, well, the different ways to read it. This VIX is telling me, just looking at it at face value, this is a doji, and it's in between this Davos box. See the green line here, the red line here, the light green line, that's the Davos box. So this is telling me that it wants to go a bit higher. So we get that second dip, test the double bottom, gets VIX up to 35. I don't think get VIX up to 55, but what the heck do I know? Okay. Gets up towards this 35, bangs it down, scares the living daylights everyone, and then collapses down towards the mean reversion, which is basically the 34 and the 50 line. One way or the other, this 34 and the 50 line is as far as I can see here, is starting to move up. So somewhere around 20 is where the VIX is going to come and rest once things start to settle down a little bit. Now remember one other thing, which markets never settle down. And given the volatility programs that are in the market, they will never be settled, because what's settled? We had a rally since 2009, and nobody ever told me, oh, the markets are really good, let's go buy it. That's behavioral finance. By the time you feel comfortable in the market, there are a million other people feeling the same way. So the Mr. Market's going to do something funky to make you uncomfortable. So this is the way I approach my trading philosophy. I always remain uncomfortable. So I wake up in the morning, and my dad used to say a long time ago, and God bless his soul, and he was a brilliant doctor, okay? He used to say, if you think life is difficult and you prepare yourself that way, then everything that comes your way is easy. Guess what? That's my philosophy, and I love it because I find everything to be difficult yet so gratifying. This trading business, it's a phenomenal business. There's an element of me always stressed, like Andy Grove's great, the founder of Intel. Only the paranoid survive, right? Isn't that the name of the book? So you always have to be paranoid about what you're doing. Just because, you can't see them doesn't mean they can't see you. So that's my philosophy. So saying all that, the VIX directly putting out there looks like it wants to go higher. If it does break down, then we have the 20 level that we're looking at. So that's a short-term rally, which needs to be sold immediately, made money and sold immediately. So the VIX is basically at this point, somebody asked me looking at the daily VIX, mind you, like what do you think is going to happen? Well, my answer is I think the VIX wants to go higher. That's it. Now, if I want to look at the RVX, which is the Russell 2000 VIX, where a lot of the commodities and the things, it's the same. Oops, sorry. This is the daily. This is a slightly different story. Okay, this to me is telling me with the way this is more of a reversal hammer. So that reversal hammer is telling me it probably wants to get down towards 24. So is it possible that the Russell 2000 diverges from the overall VIX? Yes, it is. But not all sectors have to move in tandem. Remember, commodities can rally and markets can weaken. It is possible that oil could have a rally. It is possible that the Saudi king says, enough is enough. I'm going to prop up oil prices because I can't take it anymore, because it takes a lot of money to maintain a fleet of 600 S-500s and 550s, okay, and Andrews Air Force Base and taking over the Ritz-Carlton. So I'm going to make sure oil gives me a little bit more, regardless of how much money they have in the coffers. So saying all that, let's take a look at oil. Because there's a lot of countries right now getting desperate to the point where they will do whatever it takes to move up the price of oil, technically speaking. And seasonally, we are also coming into a seasonably colder period in the Northeast here where this oil demand is going to be higher. So this is what I've been harping on. I'm looking at pure technical. So looking at, that's the reason why I've been playing the DWTI. And even that was very tricky on Friday. All right, so looking at this here, generally, I mean, technically speaking, oil's looking at about 44.68. This is the light sweet crude oil futures. So you're looking at about 44, and then the lower end of the Darvas at 43. If that happens, that DWTI basically gets up to 120, 135. If we break up over 49, I don't think oil it has that much juice to break up and go to 53. I think it corrects first. This is the daily. It's overbought. I think it corrects first before it moves higher. There's an oversupply and nothing's really changing. All right, so that's my picture on oil. Looking at DWTI, I've been playing this. Crazy chart. Okay, so this is where we are. This is where we are. This is a, what I have here is a Fibonacci retracement all the way from 236 down to the recent lows. So 130 is not magic, right there. That's the first 50% retracement. And this low, by the way, that I put there is actually not the recent low. I put the lows from what the previous low was. So let me just show you guys. So I put the lows from when nobody even knew what a DWTI was, okay? So that's 20 bucks. So when you look at this chart here, we did a beautiful 50% retracement, then we slipped below, we hit the 34, we hit the 50-day moving average. This is a 50-week moving average, this red line here. And this 50-week moving average right here, and we bounced off that. Huh? Isn't that great? Right there. Look, the 50-week moving average right there, this red line, we bounced off. So on a sharp move up, the next level is the 50% retracement level. So that is around 127. So we could get a quick 50 to 20 points on that, and I think people should take advantage of that. After all, it's like a 20% move on Netflix, right? Wow, wouldn't you take advantage of that? Why not do that with DWTI? Put a white stop, play around with it, just because it excuse my French, jerks you out on a certain day with the stops and this and that. The reality is it's liquid, it moves fast, and I don't expect oil to basically ramp up $5, $6, $7 over the next couple of days. Could be wrong, but that's just the way it is. So on that note, these are my closing comments. We're going to be entering a very volatile period starting Tuesday. Be ready for everything. I am doing something which is unique. I don't believe anybody's tried that. I haven't seen anyone in StockTwits do it, which is the Periscope. And I'm showing some very detailed stuff over short bursts of broadcast, which I think people will find hugely beneficial. For people who are looking to join my service, you have to understand something. I'm a big picture guy. I provide a lot of trade alerts and this, that, and all kinds of specific stuff, but I am not a stock timer. So I will give you entries. I will give you all kinds of great overall exits. I'll put the parameters there, but do not expect me to guide you in and out of your position. You will have to use your own cerebral matter, your gray matter, your own money. I don't know what your position sizes are. I don't know what kind of profits you're up. And then you will have to decide what you want to do from that point. If you want micromanagement of your trades, this is not the service. If you want to understand the market, if you want to get some big time moves, and we've been showing that repeatedly, even in rough markets, then you're definitely in the right place. We'll be offering quite a few more services coming up over the next couple of months. And one of the things I intend to do over the long weekend is basically go ahead and update the long-term portfolio, which is available to all Platinum members. And that long-term portfolio is, given after this market correction, it's going to look pretty damn good. There'll be a select maybe 20 or 30 stocks in there. I am not going to be micromanaging that either, but I will go ahead and put that down with possible, levels of entry and all that stuff, and you then have to manage. And every month or so, I'll look at it and I'll update it. So that's coming. Aside from that, I appreciate all your support, and keep an eye on the bigger picture. But like they say, think globally, act locally. So act on the moment. You can make a decent sum of money doing what we do. Always have a good portion of cash on the side, especially in times of volatility and massive volatility. I would say do not use a large portion of your tradable cash at any given time in any specific positions. Just use it, reuse it, and move on from there. So I'll go ahead and entertain maybe a few questions, and we'll wrap it up shortly. So go ahead with your questions. Looks like there are 22 people and I'm sure you guys will have some terrific questions. Go ahead. And you can type that in. Can everyone hear me? Okay. So so go ahead with Ratna. You have any other questions? Can you show a quick one on RUT daily weekly? Yes, absolutely. So I'm going to do something interesting here, which is look at a broad time weekly picture on the Russell 2000, which I find to be constructive, mind you. Okay, Millen? So this is what I see on the Russell 2000 when I look at this chart here. I see an inside week. See that candle? This was a large reversal from the bottom. Big one. Big money was made. It went up, ramped up from 1100 up to 1163, 160 points. Beautiful. Now, we had this corrective move during the week, and it's an inside week. So that's good. So that's good. These are short-term trend lines that I've drawn, and I've shown this on my charts. And by the way, very important reminder to a lot of new members and subscribers as well as older members. You can find every single one of my published charts, very tactical precision charts, on the Clueless website under clueless8.com/charts. My support staff goes out there and populates these charts every single evening on content that I create. So you can go in there, clueless8.com/charts, spend a couple of minutes, type in the symbols, look by month, look by symbol, and you're going to find all of them there. So keep that in mind. So the Russell 2000, looking at it here we have the broken, here's a 50 at the 34. So at this point, the best, I could see this fib level, and this fib level goes to 700, right? So the 50-day moving average is here, 1028. So a massive slip would obviously bring us down there. Everything for some reason or other, especially over a period of time, tests the 50-day moving average. Fibonacci 50% retracement. Why? That's just the way it happens. So it's so the fib is 1180. So we could very well have about 40 some points left on this, which would also retest the back end of the 50 and the 34, back end of the 50-week moving average, and that would be that'd be good. Now here's something else I noticed. Let me get these blue lines out of here. Just long-term observations that despite this huge thud in the Russell 2000, the pure hate that comes out of many analysts, traders, commentators about the Russell 2000. I mean, there are some people who make a living just hating the Russell 2000. To me, it's the U.S. small cap infantry. That's what I call it. I used to call it in StockTwits. Okay, that is American business, small business, growth. Yes, it gets overvalued. So what? When a kid's growing up, he overshoots, right? Gets taller. So yes, smaller companies tend to get overvalued, tend to move faster. They have more risk, but that's America. We take risk to grow. If America, and let me just put it this way straight out, okay? Talking about risk. This country was born out of risk. Europe and the old world, why do they call it the old world? Because they did not want to take risks. They sat on their castles while their poor suffered. And then they came here, they took risk, and look what America became. So if you think you don't want to take risk in the markets, you don't want to take risk in your lives, quantifiable risk, mind you, not asking you to go dive off the Empire State Building with the parachute, but quantifiable risk, you got to do it. So when people come to me and say, "Oh, I want to make money, but I don't want to take any risks," well, I don't know what they're smoking or how they're thinking, because I don't even have an answer for that. Okay, you cannot make money without in trading or in investing without taking risk, period. So looking at the US the Russell 2000, this is a positive phenomena on the weekly, and of course stochastics and stuff are quite oversold. The McClellan is quite oversold, and let's look at check the daily, and the daily is basically mixed picture. Like I said, going into next week, we do have again that positive divergence. Lower end of the scale, I would consider the 1124 level or so to be a more opportune buy. Okay, right there. Sorry, right there. And otherwise, a move up over 1142. Now remember, technicals are moving very quickly, so I'm just giving you a broader picture. So this also could be construed as a market structure, dragon bullish type of thing. All right, or even a test, a double test of 1100, I'd be a buy. So I like the Russell 2000 from what I can see. So that's the answer to your question. Can you show, okay, what is the Fibonacci retracement parameter called on Thinkorswim study? I'd like to add that to my thing. Okay, so very simple. You go to studies, edit studies, and just look for I'm sorry, what am I doing? What am I doing? I'm being stupid. But I'm clueless anyway. Fibonacci, very simply, go to drawings, Here's your Fibonacci retracement. So let's take an empty chart, for example. Let's take a chart of Apple. Let me get all this out. Let me clean out all the lines. Remove all drawings. Let's look at the weekly. $55. Let's look at the weekly. And let's draw the Fibonacci on it, okay? So you go to drawings, Fibonacci retracement, touch the top, bring it down all the way to the bottom when it was 55. When was that? I don't even remember when it was 55. 2013, okay. And look what Apple did. The magic of the Fibonacci retracement. What is this number? What is this number? 50? Where did Apple go? 50% retracement. Bingo! Bingo! Amazing, huh? 61% retracement. Next level. Right here. 78.6. I'm not saying it exactly does that, but you know, it is pretty much where Apple back tests, which I think it will, back tests, and then I think it fails, but it back tests the 78.6% Fibonacci level that's at 118.43. Now here's the other thing I want everyone to focus on. Weekly charts here, right? Weekly charts. So look at, sorry. So is that clear, Bhargav? I'm not seeing the Apple chart. Well, you'll have to refresh your screen. Okay? Good. So look at this massive reversal we got of 92. Just look at this for a second. Look at that. Look what we did. Now, these lines are the acceleration bands. They're not even Bollinger Bands. These are Bollinger Bands on some sort of high-level speed drugs, right? Acceleration band. That's why they're called acceleration bands, what things accelerate to. Well, guess what we did? We held the acceleration low, which is 107, same levels that I posted the other day, where Apple's going to trade 107, what did I say, 107 to 115 or something like that. So, huge bar, and look at this little consolidation doji. Inside week, that's for sure. Apple would be a completely different story if we close below 100. But this is very positive. Now, it doesn't mean that it can't slip down to 104. It can definitely come down and test the 61.8 level. But what I'm saying overall is that when you look at the weekly picture on Apple from a technical standpoint, and I repeat again, technicals can change on a whim, you are seeing a nice positive divergence here. And this is good. And a test of 104 would be fantastic. And I think Apple still gets to retesting the underside of the 50-week moving average. And if something miraculous happens and Apple gets above the yellow line, which is the 34-day moving average, I'm sorry, yes, the 34-week moving average here over 123, well, you can rest assured Apple's going to hit the highs. Okay? So that's Fibonacci. More questions, please. Any other quick questions? All right, I'm going to go over quickly the S&P 500. This has been extremely profitable, these trades that I'm doing on the SPX and for option players. This is a daily chart of the S&P 500 as I see it. It's pretty clear that the force is on the downside, even though we have some positive divergence and all that stuff. I still believe that we test 1900 and slip a little bit more. What is the stochastic divergence? I explained that a few times in this session. A stochastic divergence is when prices come down to the same level, but the internals are higher. So let me just answer Stork's thing. And Stork, you do need to take the group session so you can fully grasp it, because I go in very much in detail in many different instances. So here, let's say, for example, we have a positive divergence because this is climbing higher. So it's making higher lows. So the bottom line is that when we look at the same level here, for example, the market came down to the same level here, the stochastics were down here, right? Down here. We came down to the same level on Friday, but look what the stochastics were. They were here. So in other words, they are creating higher highs, higher lows, while the prices are coming down to the same level. That's, in general terms, is a divergence. Want to know more about it? Go into Investopedia, type in divergences. Divergences are simply where we are starting to see accumulation by money, and the selling pressure is mainly by retail investors or panic sellers or whatever the case may be. Shorts getting, stops getting triggered, while there is underlying hidden buying going on, which is creating that internal divergence. And I've seen that happen a few times. Now, remember one thing about divergences. Again, Milind, I do not use any parameters. I just use the defaults. So you can look at it. What parameter values do you know? It says here, 80, 20, 10, depending. I use fast stochastics pretty much. That's all I do. So just go in your thing and just do fast stochastics. I do not go in there to change the parameters. I just don't. Okay, just simple. Because I find this, what works for me, I don't need to tweak around with it, because I'm not that much of a mathematical technician where I'm going to tweak around and find something new that I don't find by using the defaults. I just use the defaults. So going back to what Stork mentioned, is the fact that to Stork's question, is divergences can take a couple of days to develop. So you can see it develop, and I've shown this many times, and then bang, they take off. And many, many times I've shown positive divergences, including on a very short-term basis on Friday, on the Periscope feed. I said, hey, short-term divergence is applying here on my trading view charts, and the market turned around immediately, if you guys remember that. So here, for example, there are divergences created here. This is a 1 hour reset. It's a 1 hour reset. You see the crossover as the market was coming down, but the crossover is intact. So this should lead to a quick short-term bounce, no question about it. But at the same time, you could also see this remain oversold like that. If things, it can remain oversold. Look, it remained oversold, and the market kept on going down. And then it had a little blip, market took off. And this was a case of real positive divergence. This was starting to, even though the prices were coming down here, okay, you were here, for example, it was starting to turn while prices were still coming down. And then prices hit the bottom here, but this was still higher. So the divergence worked out nicely because we had a massive rally. Of course, the rally failed. But what I'm saying is that if you look at the underlying, and over time you'll start to see this too. If you see the underlying picture, this was starting to diverge higher as the prices were coming down, because at one point, whoever the smart money is, basically knew that we're going to have a very sharp dead cat bounce or reflex reactive bounce, and that's exactly what the divergences work out. So key word is the divergences don't have to work out immediately. They might take a couple of days, but they will always work out. And the same thing happens with negative divergences. So this is certainly a positive divergence going on here, but we'll see what develops. Answer to Ratna's questions, yes, there is a very strong possibility we get a short-term bounce, and I've explained that clearly as to where we might go on the SPYs. Not everything is lost here, guys, okay? I mean, there's a lot of stuff going on, and the central banks are very aware of what's happening around the world, and there's a lot of good things that are being washed out under the table. The bears are in control right now, but then at the same time, in between that, there are stocks that are going higher. I mean, look, case in point, Priceline. I love Amazon. For the time period that we're in, and like I said, there will be selective stocks. Twitter, Facebook. How can I say? Things are very, very oversold short term. Now I'm going to show you one last chart before I sign off. And this is known as the 533. Okay, this is known as the 533 chart. Don't expect to get it from me. You know, it's something that's there. Now here, this is showing this is a swing chart. I call it the market directional bias. I can go back, let's say 6 months on this. I overlay it by normally putting the Bollinger. I put the pivot points. I put the simple moving average, and then I hit click. So look what's going on here, and this is pretty big. All right, if somebody's very, you know, on the bullish side of the picture. So what's going on here? Let me get the pen. Is a massive. Oops, sorry, I got the spotlight, not the pen. Okay, look what's going on. So honestly speaking, this can be looked on as a bull flag or a consolidation channel after a big move up. After this big move up, we basically are in a consolidation channel. What we would like to see is basically these lines, when they turn, are total buying opportunities, big time, whether it be a short-term bounce or a longer-term bounce. At this point, generally speaking, these histograms, the momentum of the histogram wants that they want to go positive. And if they go positive even a little bit, they don't have to go that high. Even if they go positive for a couple of days, you're going to see this market get up to the 2000 level. So I believe if the S&P gets towards the 2000 level, connects with all those lines that I'm showing you, you know, the Davos box, the 3450 moving averages, all that stuff, this will overshoot into positive territory. Once it does that, and next time I show the swing 533s on the Twitter feed or on the end of the day reports, you know, I actually give a whole lesson on how to read this thing. There's a lot of different ways to read it. Once you get up there, you want to basically sell. And this is more of a swing trade type of thing. All right. Once you get this deep oversold on the RSI, obviously it's a huge buying opportunity, one with other. We got deep oversold. We stayed deep oversold all the way here, and then came this humongous bounce. And then that created an overbought condition up here immediately. Again, the speed of the machines. Then we got oversold again here, and now we are here. Now, does this get more oversold? We don't know yet. Does it bounce from here? It's very possible, but there are many different ways to read it. But this is a very powerful swing picture that's telling me that there's a possibility that we are going to basically continue, that the positive divergences keep on continuing despite the lower prices, and then all of a sudden you wake up one morning and the market's up 600 points. And it's happened a few times in this last 2 weeks. Showing you the Russell 2000. So we look at the Russell 2000. Wow, look at this. The Russell 2000. The Russell 2000 is almost going green. Wild, huh? Look at that. That's why I said the Russell has more juice than the S&P at this point. Something is going on. So at this point, if this moves up, we're going to be looking at 1180. It's a lot of money to be made. We're looking at the pivot point. This is the pivot, so that's around 1170, first level. A retest of the 50 would be down somewhere around 1200. I'm not even going that far. Even if we go up here, the Russell closed at 1136, right? So you're looking at you're looking at 40 points. That's a couple of 100% on that trade. So this is definitely a big positive. This is about to go green. All right. So listen, guys, I'm going to wrap up. I think this was hugely helpful to a lot of people. Continue with what you're doing. The only thing I want from you guys is this. I need you to promote the service between your friends, your colleagues, other social networks that you're on. We are growing rapidly, and we're going to be going a lot faster. I'm producing a lot more visual content because I'm deep down a visual trader. Charts talk to me. In the meantime, I'm sharing what I know, what I understand, and I'll keep on doing my best. And that's pretty much the best I can promise. And in the meantime, we have a lot of precision hits. You have to manage your own trades. I'm going to engage each one of you during good days, bad days, ugly days, like I've always done. But as in managing your own specific trades, I will provide the entries. I'll provide a broad exit. You'll have to manage that along the way. And that's basically it. Any quick comments before I sign off? Mr. Koffler, one last plug. Anybody who's trying to basically clutching their pocket and saying, oh my God, I'm not going to sign up for the group coaching sessions and things like that, in my opinion, are making a fundamental mistake. Because the way I go over things in detail in different segments of the on the 5-session group session, in depth, is going to be hugely beneficial. It's going to be hugely beneficial for 2 reasons. One, you're going to lose less, and 2, you're going to make more. Because it's not getting into the trade, it's managing the trade that matters. So how you're going to manage the trade is you're going to keep an eye on the bigger picture. And if you look at all these different things, and a few things that I explained, that allows you to stay in the trade. Otherwise, just going to be just flailing around and not sure what you're doing. So invest those few dollars in doing that. No, keep on asking me the same question, Stark. I've explained to you clearly. We have 5 segments of the session. We just don't talk about market trends. We talk about behavioral game theory. We talk about different proxies that we look at. So, like I said, you need to spend some time going into the website, looking at all the different segments that are there on what these sessions offer. And no, we just don't talk about market trends. We talk about things which matter to the markets. Market trends, behavioral finance, all kinds of deep technical stuff. We talk about global macroeconomic game theory, how things work, how I've seen work, what I understand. So we basically, we talk some serious stuff. And no, it's not just about market trends. All right, guys, I'm going to sign off. Thank you for listening. And do spread the word around, and see you guys on Tuesday, bright and fresh. Okay?